The $40 trillion dilemma. If you could choose only one investment for the rest of your life, which would it be? Most investing experts agree that the answer comes down to two Vanguard giants, VOO and VTI. But here's the catch. Even though these ETFs look almost identical on the surface, choosing the wrong one could cost you years of financial freedom. Or even worse, leave you on the sidelines while the biggest market winners of the next decade take off. Today, we're settling this debate once and for all, so you'll know exactly which ETF is more likely to get you to retirement faster. Breaking it down inside the giants. To understand which ETF deserves your money, we first need to look under the hood. The Vanguard S&P 500 ETF, better known as VOO, is considered the gold standard of passive investing. It tracks the 500 largest and most profitable companies in the United States, household names like Apple, Microsoft, Amazon, and Alphabet. When you invest in VOO, you're betting on corporate America's elite. Companies that have repeatedly proven their ability to survive recessions, adapt to change, and generate enormous profits. Then there's VTI, the Vanguard Total Stock Market ETF. Unlike VOO, VTI doesn't stop at the largest 500 companies. Its goal is to capture virtually the entire U.S. stock market. That includes every company in VOO, plus roughly 3,200 additional small and mid-cap businesses. Think of it this way. VOO is like buying the starting lineup of a championship team. VTI is like owning every player across every league. At first glance, VTI seems like the safer choice because of its extreme diversification, but as you'll soon see, owning more companies doesn't automatically mean you'll reach financial freedom any faster. One thing both ETFs have in common is their incredibly low 0.03% expense ratio. That means if you invest $10,000, you're paying just $3 per year in management fees. On cost, it's essentially a tie. The real differences begin to emerge when you compare their sector allocations, especially their exposure to technology versus more traditional industries. The diversification myth. Many investors choose VTI because they believe owning more stocks automatically means taking less risk. But here's something most people don't realize. Since both ETFs are market cap weighted, VOO and VTI share roughly 80% of their DNA. The companies in the S&P 500 account for the overwhelming majority of the total U.S. stock market's value. And so or and sound so and for I and L and not means when Apple rises or falls, both ETFs tend to move almost in lockstep. The real difference lies in the remaining 20%. That's where VTI holds thousands of small-cap companies. Historically, smaller businesses have had greater growth potential. After all, it's much easier for a $500 million company to double in size than it is for a $3 trillion giant like NVIDIA, but that upside comes with significantly more volatility. During recessions or periods of high interest rates, like we experienced in 2022, small-cap stocks often decline much more sharply. Looking back over the past decade, the dominance of big tech has clearly favored VOO. But if you zoom out to earlier market cycles, such as the 1970s or 1980s, small-cap stocks were some of the biggest drivers. So the real question isn't simply which ETF is better, it's which economic cycle we're entering and how much volatility you're willing to tolerate along the way. The historical performance factor. Now let's talk about the numbers. If you had invested $10,000 in VOO 10 years ago, your portfolio would look noticeably different. Over the past decade, VOO has delivered an average annual return of about 12.8%, while VTI has trailed slightly at around 12.1%. At first glance, a 0.7% difference doesn't sound like much, but over a 30-year retirement portfolio, that gap can grow into tens of thousands of dollars thanks to compound growth. Why has VOO pulled ahead? The answer is simple. The explosive rise of artificial intelligence and software has overwhelmingly benefited the largest technology companies. Businesses like Meta and Tesla have grown to a scale that most of VTI's smaller companies simply can't match. But history reminds us that market leadership changes. After the dot-com bubble burst in the early 2000s, VTI actually outperformed VOO. That brings us to one of the most important investing decisions you'll ever make. VOO is a bet on today's proven market leaders. VTI is a bet on the entire U.S. economy. Do you prefer the stability of today's champions or the growth potential of tomorrow's unicorns? The big reveal: which ETF actually wins? Statistically, the difference between the two is so small that your investing behavior will matter far more than your ETF selection. If you're a younger investor with a 20 to 30-year time horizon, VTI offers a theoretical advantage through exposure to the small-cap value factor. However, if you're approaching retirement, or simply prefer sleeping better at night, VOO has historically shown greater resilience. The correlation between these two ETFs is approximately 0.99. In other words, they move in the same direction 99% of the time. The real mistake isn't choosing one over the other, it's chasing performance. Too many investors sell VTI to buy VOO after large-cap stocks have already had an incredible run. Nanani, da no, sabranoraman ma, and da, enism der baber, gerbir. Fast factor determining whether you'll retire early isn't an extra 0 for an annual return, it's how much you save. Pick one, automate your investments, stay consistent, and let time do the heavy lifting. Thanks for watching, and I'll see you in the next video.